When are they going to learn their lesson and how to read data effectively? Good evening, everybody. It is Wednesday evening. The inflation figures for September have come out. We're going to be crunching the numbers today through this live session. We are live, so if you can hear me and you can see me, please give me a thumbs up. Please say something in the comments. And if you are watching this on the replay, again, please play as if it is a live stream. Play full out. Ask those questions. I'll always get back to you. So, look, the big news today is that inflation is stuck. It's stuck. And I'm just going to head straight to the slide deck, actually. Yesterday, I was looking through headlines to try and gauge where the experts, the analysts, thought that inflation was going to go. And everybody was talking about a drop, probably to about the 6.5% mark. And so, therefore, when the data came out today, when the print came out today, and it actually was stuck, there was all of this surprise, okay? People were talking about, oh my gosh, unexpectedly, it stuck. Mainstream media talking about it. Even a lot of narrators in YouTube and the social sphere going, whoa, wasn't expecting that. Was expecting inflation to come down to about 6.5%. It stuck. What's going on? And I've even seen people say the reason that it stuck is because of the conflict that is brewing, or the crisis, indeed, that is brewing with Gaza. Let's just put that to bed for the moment. I'll put that to bed. I want to put it to bed because this channel is completely apolitical. I'm not going to talk about what's going on there, other than it's going to have an impact as we go further into the year and in the beginning of 2024, but it's not going to have any bearing on the data that we just saw today. Okay, so could we have predicted this? Yes, I believe we could have. And what I'd like to do is start by doing a recap of what I talked about last month, when last month's inflation data. Now, these slides are actually taken from last month's presentation, looking at the August CPI print. At the end of that presentation, I talked about some possible hypotheses of what's going to happen for the rest of the year. And I said in October 23, that's this one, the one that's just come out, potentially seeing a rise in CPIH. And then potentially, and I know it's not October because the next MPC meeting is first week of November, but potentially a small rate rise off the back of that. That was my prediction. November, so next month's print, we're going to see a large drop. I'll talk to you about why I think this in a moment. And then as we go into December, into Q1 next year, it's going to look sticky. And potentially we might see another interest rate rise then. Okay, so why did we think that? This was, again, taken from last month's presentation. We looked at the data, and sorry, I'm on my laptop. I'm not on my iPad, so it's going to be difficult to zoom in and have a look at it. You're going to have to sort of put your glass on if you can't see that. But one of the things with inflation that is really vital to understand is that it's calculated on a monthly rolling basis. Okay, so we can see the figures that drop out of the data set, which will be effectively a year ago. So when we look at this chart, you can see that this thing I've got circled in purple was September 2022, which was the 1 month CPIH rate. And I'm going to define and talk, just in case people are confused with all the figures that people talk about. We've got CPI, we've got CPIH, we've got core inflation, we've got owner-occupied housing costs. I'm going to help you and sort of define all of those as we go through. But September 2022, CPIH was month-on-month 0.4% rise. Okay, now, actually, last month, this year, we saw it was a 0.4% rise, but it was trending up. So when we looked at effectively the inject of the increase in Brent crude and how that's filtering into the system, the trends are all there that inflation we're having a bit of a sort of, swell of inflation off the back of the price of Brent crude, going from sort of low 70s a barrel in terms of US dollar to, I think it hit sort of 96, 97 a dollar before it did then come back down a little bit. We'll look at Brent again in a bit. Anyway, with that filtering into the system and looking at the price of Brent through September, it was pretty obvious that we're going to see some more inflationary effects. So if last month was 0.4% month on month, I predicted that this month would be more than 0.4%. And indeed, when we look at the data in a sec, this month we saw a 0.5% month on month increase in CPIH. Now, because it's a 12-month rolling data set, when this 0.4 drops out and we've just put a 0.5 in, it's going to actually make it a larger overall year-on-year change, if that makes sense. So we've had 0.4 drop out, the data set, and now we've had 0.5 this month drop in. So actually, and we'll talk about this in a sec, there's an anomaly there. It probably should have gone up, CPIH. Why didn't it? If we look at this red box, right, this is October 2022, you can see the month-on-month CPIH is 1.6, which is a massive spike. And in fact, it's probably fair to say that in 2022, the October print was the sort of the peak of the inflation at the end of last year. Now, next month, that's going to fall out of the data set. Okay, so next month we would expect, unless month on month goes ballistic during this month, which is, it could happen. We'll talk about world events later on. It could happen, but the chances are we'll see a decent drop next month as that 1.6% month on month drops off. I hope that makes sense in terms of understanding the data. And I just think that if anybody takes 5 to 10 minutes to actually look at this data, let me just come off this. If anybody takes 5 to 10 minutes to actually look at the figures, right, and spend a little time analyzing, they're going to come up with much better conclusions. Because I was genuinely surprised when I saw all of the mainstream media and the analysts and the experts predicting a drop this month. Bearing in mind, I forecast a slight rise this month. I was also quite surprised seeing a lot of commentators surprised that we saw, we haven't seen a drop this month. But when you look at it, it's fairly obvious when you look at that data set, in terms of what was going to happen. So there we go. I find that interesting. So that was prediction. Right. Before we talk about this month's print that dropped today, I would like to ask everybody a favor. Now, those of you who know me, those of you who are regular subscribers, welcome back. Those of you who are new subscribers, a massively warm welcome for joining the community. And I want to give you my vision of what I'm doing here on this channel, and it is building a community. And it's a community where I am working to give you authentic data, get through the hyperbole, get through the headlines, right? Get through the mainstream media and the sort of, the narratives that are on the social sphere to give you real objective data that sits underneath that to enable you to make better decisions, and better decisions ultimately to invest in your future, right? I have a vision, I have a mission to help people take ownership of controlling their financial future. So how can you help do that? The more subscribers we get to this channel, the more resources I can put into this, the more people I can reach, the more effort I can put in, the more shows I can do, the more data I can get out, the more I can do production value. So I would just like to share with you this data set, right? We are seeing, you can see here, this purple line are returning subscribers. So you can see that every time I go live, we have a lot of returning people come to the channel. So we are building a community. But you can probably also see that there's a very small percentage of views on the channel that turn into subscribers, about 0.01%. So I'd like to ask you just this one favor, and that is to help me grow this channel to get you better resources, better data, better content by just hitting that subscribe button now. That's all you need to do. It's the only favor I'm ever going to ask you. Please do it now. I'll never ask you anything else, and in return, I'll carry on doing these and helping you make better decisions. Hey, Sean, how are you doing? Awesome. By the way, just in case you haven't been on one of these live streams before, I'm going to go through the slide deck as quickly as possible because I know people watching on the replay just want to go through and see the data, and then we'll get into discussion afterwards. So let's have a look at the overview of what happened this month. It is flat, right? We have flatlined. CPI is unchanged at 6.7% month on month. CPIH is unchanged at 6.3% month on month. Core CPI is technically down a little bit, 6.2% to 6.1%. Okay. Core CPIH is unchanged at 5.9%. And this is a big one. Here's the big one. Owner-occupier housing costs are up from 4.8% to 5% month on month. And I would suggest the rate is accelerating. This is a major factor that's now coming into the data, into the CPI data. And also, I believe, is going to have a material and empirical impact into the UK property market, as we see what is effectively not just cost of living, but cost of home ownership crisis continue as interest rates stay high persistently for longer. We'll talk about that later as well. So effectively, we are flat. Nothing has happened, which is bad news. When we look at the graph, okay, we can see we've had this little tick on the right-hand side where it's, sort of flatlined. The graph that the thing that I really want to point out on this graph is that bottom line, that dark blue line at the bottom, which is owner-occupier housing costs, which you can see is accelerating up. And it's not going to be long until that owner-occupier housing cost is meeting the actual CPI line, right? And when that starts to exceed, it's going to be very difficult to keep inflation coming down, certainly to get to a 2% target when we've got a continued uptrend in owner-occupier housing costs. Now, don't get me started on weightings, right? We talked about this to death last month in terms of how the weightings for owner-occupier housing costs, that's cost of mortgage, cost of owning a home, and actually rental as well, rental amounts, how the weighting of that feeds into the data has actually been pared back at the beginning of this year. we won't get into that conversation today because I think it has a disproportionately large impact onto people's day-to-day lives rather than, the potential shop of basket of goods that the rest of CPI covers. So that is going up. That's quite a major thing. If we look at effectively, this is the graph I showed you earlier. Sorry, I'm trying to see it myself without my glasses on. I'm going to have to put my specs on to see it without without zooming in. Okay, so we're at the bottom here, September. You can see we've had that 0.5% month on month in September on the CPIH. Now, the reason I keep talking about the CPIH data is the ONS itself says that CPIH is the most accurate way of defining inflation. And just to talk about the difference, CPI is, CPIH is everything. So it includes your housing costs. That's what the H means. The H stands for housing. CPI strips out the housing costs, which I think is a sort of a strange thing to do because I think your housing costs for a lot of people are very relevant to how much things are costing. So anyway, CPI 1 month rate is 0.5. And again, if you look at that, compare it to September 2022, 0.4. So you can see we have had, right, a 0.4 drop off and a 0.5 drop in. Now, that means there's an anomaly in the data. If we had 0.4% in September 22, we've got 0.5% now, right? I would kind of ask, how is CPIH level year on year? Now, of course, I know it's not just as linear as that. I know it's not just 0.4% off, 0.5% on, because it's different amounts, different weightings, all of that sort of stuff. Is there some rounding going on? I'm fairly confident, right, that actually if you went to some decimal places, you actually see CPIH has ticked up this month. And my prediction was CPI to go up this month. So I'm fairly confident we've actually achieved that. But I think saying it's level versus saying it's ticked up, right, is a big difference for Bank of England, big difference for UK government, right? If it had ticked up, that would have been really bad news. Level, they can kind of get away with it without sort of scaring too many people. So I'd suggest there might be some rounding errors in there. I'd love to get your views on that. So let's look at some of these individual elements. To be honest, this graph or this table is a little bit difficult to read, especially when I can't zoom in. So I'm going to zoom in there. So I've pre-prepared some of these to go. In fact, let me go back a slide. At the bottom, so I've cut this table in two. Right, this table shows all the individual items, and then look, I'm not going to break down all the items this month because I don't think that's relevant this month. I want to look at the bottom of the table, which is looking at the core CPIH. Okay, so we've got goods, and this is where we want to look at. This is the month on month, 0.7% up. Services 0.4% up. CPIH, so this excluding food, energy, alcohol, and tobacco, this is core CPIH 0.5. Okay, just some figures for you there. We're going to compare this with last month, and we'll see that we're actually accelerating away slightly in terms of the services, especially. Now, this is better to look at, better to watch, rather than looking at that table. This shows all of those individual elements of the CPI basket, or the CPIH basket, and what their net effect has been over the month. Contributions to the change in annual CPIH over the month. So anything that is negative is making CPIH lower. Anything that's positive is also making it higher, and we've got a few that are level. So interestingly, this month we only have 3 items that are bringing inflation down. And the big one, the disproportionately big one, is food and non-alcoholic beverages. There's been a lot of chat about rate of change of food coming down. It's still high, right? But it's coming down. That's the biggest contributor for it balancing out. But at the bottom, look at transport. Transport, and this is most of a lot of transport is cost of motor fuel. We'll look at the graph of that in a sec. You can see how that is disproportionately dragging it up. So again, we've got push-pull factors, but this month we've got a lot more pull keeping it up versus the push taking it down again, okay? Now, I'm going to talk at the end of this about trends and where everything's heading, and I'm going to compare this to last month's chart when we looked at this in a sec, so I won't ruin that for now. Look, I've covered CPI versus CPIH. It's important to understand which one you're looking at. Remember, just remember, CPIH has got all the housing costs in. CPI has it stripped out. We have to understand the data sets we're looking at because we can spin data. Let me take those off. We can spin data fairly easily. I saw this article from BBC saying core inflation is falling as of this print. And core inflation is falling if you look at CPI. But if you look at CPIH, it's not. So we can spin stats, right, however we want to. ONS says CPIH is the most relevant. CPIH is not falling. Slightly misleading headline there from the BBC. I just like to call out some of this stuff that I see in mainstream media and on other spaces, because I think it's easy to mislead people and give people the wrong idea. Because you could look at that in headline, core inflation is falling, and going, oh, actually, even though CPI is leveled off, core inflation is still coming down, so everything's brilliant. No, CPIH has not fallen this month. That's important. That, by the way, if you want to look through the report, you have all the tables for CPIH and CPI. This is a CPI one. It's slightly different to CPIH. So when you look at CPIH, okay, again, you can see, I've already shown you this, goods up 0.7, services up 0.4, overall CPIH excluding food, energy, alcohol, and tobacco is 0.5. Let's take that and look at some trends, okay? So we've just had a look at this. This is this month. This was last month, and sorry for the green scrolling. That's when I was on my iPad and scrolling on the slide deck. You can see that last month was a lot more balanced, okay? In terms of factors dragging it down, we've got 1, 2, 3, 4, 5. There's 6 of the individual sub-elements dragging or taking CPI down. And we've got 1, 2, 3, 4, 5, 6 coming up, okay? Let's just go back to the one we've got this month. They've actually structured it more nicely on this graph. We've only got 3 coming down. We've got 1, 2, 3, 4, 5, 6, 7 up and 3 levels. So when we look at trends, and I like to look at this to look at all those elements in the basket of data. We're trending from having a trend down in inflation, and we're now seeing those trends reversing. Okay, and these trends don't just suddenly go on a sixpence. They don't just suddenly turn right angles. These trends could take months. For me, that is a starting to look at a trend reversal for inflation creeping back in, if I'm totally honest. What else? What other trends have we got? So there we go. Yeah, August 23, 6 sectors showing monthly drops. September 23, 3 sectors showing monthly drops. The 3 sectors that showed monthly drops in this data set were food, furniture, and miscellaneous goods. So let's take food out of it, right? Because that's the big contributor. The only other things that have come down are furniture and miscellaneous goods. Pretty much everything else has gone up. That is not good news. Okay. And then when we compare the core CPIH in this month to the core CPIH last month, as you can see, we've got this month 0.7 for goods. Last month was 0.6. For services, 0.4. Last month was 0.2. And overall CPIH or core CPIH, 0.5. This is month on month, by the way. And last month, 0.2. So you can see everything has crept up this month on those core CPIH figures. Trend looks to be doing exactly what we thought it was going to do, which was get sticky at this sort of point until we get to next month. So next month, we will see that big drop in the headline because of last year's 1.6 up, but everything is looking more sticky. I've seen some people on the chat talking about stickiness, and we'll talk about that in a sec. Just to show some more trends, this is when we break down the owner-occupier housing cost. So this is the element that's in CPIH, but not in CPI. And the big issue, the big thing we've got to look at, right, are these 2 bars down the bottom. The sort of burgundy one, if you like, is owner-occupier housing cost. The green one is rent. Both of these, month on month, are still getting larger. So we have not peaked. And if anything, they look like they're starting to accelerate away. So the light blue, by the way, is utility costs. You can see utility costs has come right down in terms, by the way, don't forget, this is not overall cost. This is rate of change. There's a difference between nominal and rate of change. This is the rate of change of stuff. That's what CPI is tracking. So those owner-occupied housing costs are getting bigger every single month. That's another trend. Trend comparing us to Europe and US, right? We're not doing well compared to everybody else. But let's just summarize that before I go on and talk about Brent crude. Just to summarize, so we have seen stickiness in core CPIH has not come down, right? We've actually seen, when you look at it, goods and services are going up. Have gone up month on month, not year on year, month on month. So that trend. So year on year can be misleading. Month on month, they're going up. Owner-occupier housing costs and rent are going up month by month and have been for many, many months now. Okay, that chart is now starting to get to the same sort of level as the CPI coming down. Right, and when they come into each other, right? Do we think that's going to carry on going up and CPI is going to carry on coming down to that 2% target? No, of course it's not. Right, this is where we're going to get this massive break on the system and stickiness that's going to come into the system, I suspect, in Q1 of next year. So that is where we are in terms of the CPI print that's come out. I'm just going to look at a few questions before I go on and talk about Brent crude. We've got Sean, evening. Yeah, there we go. Sticky inflation we've been talking about. Absolutely, Sean. Very good, chicken. Hi, Rob. Is OOH largely increased mortgage costs? OOH, so owner occupied housing. This is a really interesting one. Is it mortgage costs? So I'm going to say to you, I don't believe it is mortgage costs. I'm probably going to have some people shout at me right now and go, "You're wrong. It is mortgage costs. That's how they calculate it." Because I've seen several other very high-profile commentators talk about OOH and say it is directly related to your mortgage costs, and therefore it's going to get a lot bigger next year as more people come off fixed-rate debt and go on to, go on to higher rate debt. So that's still to filter in. Now I've done a lot of research into it, and I might be wrong. Okay, I'm not saying I'm a complete expert on everything. I might be wrong, but the way they calculate mortgage costs, and it is put into, when you look at the basket, mortgage costs is a line. It's not actually people's mortgage costs. It's impossible to have an accurate mortgage cost out there because everybody's on different products, everybody's on different rates. Some people are fixed, some people are not. So it's not a fair or a level playing field. So the ONS has three ways that they calculate this mortgage cost. One is actual mortgage costs. There's another one I can't quite remember, but then one is called rental equivalency value, right? So rather than taking the cost of owning your home as the cost of your mortgage, they take the cost of owning your home as if you are renting the equivalent home. So then it puts everybody on a level playing field. And I would say with 95, maybe more, 99% certainty, that is the figure that actually goes into the CPI print, is this rental equivalency value. So actually as rents come up, it's going to go up. But the rent, if that's correct, rents have not been going up as much as some people's mortgages have, and so there could be sort of an underplay of that figure if that is what's going on the rental equivalency value, because rents are going up sort of 10% a year for new rents. If you look at all rents, it's probably 5-6% a year overall when you look at the figures. I would suggest a lot of people's mortgages are going up by considerably more than 5% or 6% every year. So there we go. That's my thoughts on, is it mortgage? Is it actual mortgage costs? Or is it rental equivalency value? All right, let's move on, team. Let's move on. Sorry, I hate not having an iPad. It's so much more clunky doing this on my computer. One of the things that we talked about a lot last month was the cost of Brent and seeing that filter into the supply chain. And we peaked about a month ago at above $95 a barrel. And then actually, probably somewhat surprisingly, it dropped down again. Now, of course, we have world events that are overtaking us. And something that I always say on this channel is we look at trends. We can never predict exactly what's going to happen. Those people who come up and say housing market's going to be dropping by 4.5% by the end of this year, right? They're just doing it to get clicks and they're just doing it to try and stand out. Nobody can predict with any certainty what's going to happen. We have a quantum of probabilities. And on that quantum of probabilities, I should probably be on the screen. On that quantum of probabilities, we have different ranges of possibilities or different likelihoods, right? Or let's say we have a quantum of possibilities and then we have different ranges of probabilities on that quantum. So all we can do is look at trends and then try and see what's going on from a macro level and see, are those trends going to continue? Are they going to accelerate? Are they going to decelerate? Are they going to reverse? And when we look at that in a short term or even a medium term or a long term time period, it means we can make better decisions about what we're doing. So Brent was trending up quite significantly, and then it came down. Now, over the last week, there's obviously been significant geopolitical crisis emerging in Israel with Gaza Strip and what's going on there, and that inevitably is going to play into all of these figures over the coming months. Do we know exactly what's going to happen? No. Is it a potential tinderbox? Yes. Can this spill out into other areas of the region? Yes. Is it going to affect oil prices? Of course, it probably will do. Okay. So if we have a look at the latest spot price of Brent, you can see over here we have this dip down where it spiked down sort of beginning of October, and now it's on its way back up again. And I believe that is linked to what's going on in the Middle East at the moment. And of course, that if that continues, that's going to feed in over the next few months. We don't know to what extent. We cannot predict to what extent. Nobody knows what's going to happen. Okay, but clearly it's not a good situation. And, if you take ourselves back to what happened last year with the Russian invasion of Ukraine, that was the trigger event that started pretty much, well, not pretty much. There's obviously lots of cumulative events that got us there, but that was a trigger event that sort of saw a lot of inflation spiking with energy crisis, grain, fertilizer, all of these things coming in short supply, which obviously put a lot of costs up. When you put it, when you also combine that with the supply shock from COVID and to some extent Brexit in this country, which is probably why we're doing worse than everybody else. So that's where we are with Brent. When we look at that and we look at the transport inflation sub figure, if you like, this sort of line that spiked down is now spiking back up. That is the cost of motor fuels. And again, the reason it spiked down and we're still in negative, so we're actually in negative here. So year on year, we're actually still showing a decline in the rate of inflation for motor fuels because it was so high last year. It won't be long until we go into positive again. And actually, if you see the light blue line there, which is transport in general, transport now is contributing in a positive way to inflation. But I say positive, I mean it's putting it up, rather than negative, which is taking it down, if that makes sense. So that is likely to continue to trend up. That is likely to continue to going into the supply chain. And I believe that is likely to make inflation stickier than we think. Next month, we'll see a decent drop, right? I do not suddenly think we're going to see a 1 to 1.5% month on month in November, well, October, release in November is possible, but I don't think we would do. So we'll likely see a decent drop next month. But then when we look at the next 3 months, right, we've got a net 0.4% increase in the 3 months. So in a whole quarter, we've got plus 0.4, plus 0.4, minus 0.4 over the next 3 months coming out of the last 12 month rolling, which means we have a net plus 0.4% in a whole quarter, which is not a lot. And if we're sitting at 0.5% a month on month inflation, right, and we put in 1.5% inflation in 3 months, and we're seeing plus 0.4% drop out from the trailing, the last trailing quarter of the last year, we're going to probably see inflation come back up in the first quarter of next year. That would be a prediction. So not even sticky, maybe even rising slightly as we go into sort of January, February 2024. Those are my thoughts on that. What is this going to do to interest rates? Look, some analysis from mainstream media. What's this going to do with Bank of England? They're going to have a dilemma. What to do with interest rates. I didn't manage to snap this, and you probably can't see it on my phone, so it's probably too bright. But I've got the SONIA swap rate in front of me, and I always look at the 5-year as a guide. SONIA swap rate right now, or current today, is 4.688%. Last year, yesterday, time flies, doesn't it? Yesterday it was 4.533%. So we've gone up by 0.15% in a day on the SONIA swap. So that is the market, sort of for the first time. I haven't seen this 5-year swap rate go up for a while. It's been a steady decline, which of course is what feeds into mortgage rates. But that's the first time we've seen the SONIA swap rate spike up. We'll see what happens over the next few days. Markets have a tendency to overreact. But let's just keep an eye on that, because that will again start filtering into the mortgage market if this inflation is sticky, and we've obviously got more sort of geopolitical issues that we're contending with. So I saw an article today, I can't remember where it was, talking about mortgage rates hitting 4.6%, 5-year fixes, 4.6% by the end of this year. I don't know exactly what they are right now in terms of average 5-year fix or 2-year fix, but I'd imagine we're going to see at best a leveling off of fixed rates. And if this continues, they'll start creeping up a little bit again, rather than coming down, which again is going to feed into the housing market. So let's get to that. We've had this is right. The other thing with interest rates to bear in mind is we've got inflation. That's one thing they look at. The next thing they look at is wage growth. And for the first time, so we've got some contradictory data that's coming out here. Number one is we are now in real-time increase in wages. Okay, so wages are now above inflation. You can see that here. That's the sort of, this is a trailing 3-month figure. So it's not just like a spot figure, it's trailing 3 month. So we have seen wages, light blue line, go above the sort of red line of inflation. When you sort of look at this whole period though, so what's that? That's sort of mid to end of 2021. We've been in real-time wage decline in terms of real terms, because wage growth, yes, has been strong, but it's been lower than that significant inflation. So it's not like we're now just above inflation and all of a sudden everybody's flush with cash. We've seen a big net savings outflow over the last 18 months. People have had their real spending power eroded. And just because we've tipped into real-time wage growth does not necessarily mean everybody's all of a sudden very wealthy. However, it's something that's going to feed into the Bank of England decision when they see this and they go, okay, wage growth is now above inflation. So we've got real-time wage growth. So that obviously the reason for that being part of the inflation discussion, the interest rate discussion, is when people are becoming more wealthy, and by definition, if your wage growth is more than inflation, you are becoming more wealthy. They'll have more spending power, go out and spend stuff. So you've got to put interest rates up, stop people spending, rather have them save stuff. However, on a contradictory article, and this was from the FT this morning, a lot of people are now saying wage growth has peaked. So if we look at this light blue rate of growth graph here, this is the ONS average. It looks to have peaked and the wage growth is starting to come down. So if we see the rate of growth start to come down and inflation stays sticky, it might be short-lived with that wage growth sitting above inflation being real-term wage growth. So some contradictory factors for the Bank of England to consider. But on balance, looking at this inflation data, right, we still do have real-time wage growth as we go into, I think it's November the 2nd, the next MPC meeting. Yesterday, I think people were saying 25% chance of an interest rate rise. I would say it's significantly higher than that right now. The other thing with wages, if we peaked and they're not coming down, but the rate of growth is slowing down, is this a leading indicator of the state of the economy? Don't forget, the economy and the housing market are symbiotically linked. Okay, housing market crashes big time, it's probably going to take the economy with it. Vice versa, economy crashes big time, it's probably going to take the housing market with it, because there's a perception of spending power based on how wealthy people think they are. So is this a leading indicator of the economy? Next CPI print prediction, we've talked about it. I think it'll be a significant drop. How significant? So I think, it could come below 6. That would be big news. Big news wouldn't be big news. It would be exactly what sort of predict. It could well come below 6. Remember, Sunak's target is 5 by December. So actually, that's a long way to go from here in what is 2 months. I can't see. I'm not going to state my reputation. I think you might be struggling to hit it now. What we'll probably say is that December's data comes out in January. So actually, it's the January one we have to look at. I don't know. We'll see how much. So month on month, remember, last month it was 0.4. I'm talking about CPIH, 0.4% month on month. This month, 0.5%. If we see Brent crude carry on going up, could we go 0.6%? And if it was minus 1.6, we might drop down. So we might drop down 1%. So we might be sort of high fives. High fives. Might be high fives next month. And then it might stall before we get down to the 5. We will see. We will wait and see. What's your thoughts? Let me know on the comments. Let me know. And by the way, sorry, I do apologize if I've been a little bit staccato today and not quite getting my sentences out. Just to give you a little bit of insight, I'm moving house right now. I'm literally in the middle of moving house. This is the last time I'm going to be live streaming from this studio, which has been my pride and my joy since setting it up in February of this year. I'm actually in sort of a workshop in an outdoor building in the grounds of the property I'm in, but we're moving back to Winchester. So I'm also moving furniture up to Chester in some of our service accommodation units. So over the last 6 days, I've done Chester and back 4 times with a Luton van. We're packing up a Luton van all day, and then tomorrow is the big move. So we've got 2 or 3 days worth of moving into the new pad, and then I'll be obviously setting up the new studio. So it's slightly emotional that this is the last live stream from this original studio, but I'm not going to lie, I'm slightly fatigued after probably about 1,000 miles of driving over the last few days and loading up and unloading the best part of a 6-bedroom house with lots of kids. So apologies if it's a little bit stuttery. I'll get some more rest next week. Right, okay, team, let's go. That's what I've got on CPI and inflation and what's going to happen, or what I believe is going to happen. Ultimately, everything that I spoke about last month, I believe is happening. Okay, so when you look at the data, you can understand what's going to happen. It means it doesn't surprise you when what you think happens actually happens, rather than what the mainstream. I don't know what they look at, to be honest. When the experts and the analysts come up with these figures like 6.5%, which is what they thought it was going to come down to, that seems to be the general consensus. I'm interested to see if they're looking at different stuff. If they get, do they get released different data sets or things like that? It just seemed fairly obvious with the trends from last month, with crude feeding into the system and the 0.4 dropping off from last September. It was not going to drop. unless we saw, unless food came down, and food has come down massively, by the way. Food's come down massively, and it's still not dropped the overall figure. So that kind of shows where we are overall as a figure. Right, let's have a look at the questions. Health is wealth. Hello, Health. How are you doing? Why are we mirroring the Fed, forgetting our inflation is double theirs? Yeah, very true. We need higher rates as last few months' inflation has hardly moved down, signaling our rates are too low. Yeah, it's a good question. We do tend to mirror our friends, our cousins over the pond, don't we? I agree. Look, I'm just going to grab let me grab the slides. You say the last few months. I know you can't see this. I'm just sort of going to try and zoom it in. In fact, what I'm going to do is I'm going to come off the main slide deck and zoom in on my thing so I can actually read it. I want to see the last few months, what's actually happened. So we've got, that is CPIH. So, is that right? CPIH index, 12-month rate. There we go. Let's go for the CPI because that's what everybody talks about. So the last 3 months, right, we've been 6.8, 6.7, 6.7. So effectively in a quarter, we've dropped 0.1% in a quarter. So health as wealth, you're absolutely spot on, right? That is now sluggish. Now, obviously, we had a couple of months of drop. So if you look at, and again, sorry, I know you can't see this. I'm just reading this off my screen. If we look at May and June, we went 8.7 to 7.9, and then 7.9 to 6.8. So we went from 8.7 to 6.8, almost a drop of 2% in 2 months. And that's when everybody started clapping and high-fiving and saying, look, we're all good. We've solved inflation. It's done, right? Swap rates came down massively. Mortgage rates eased. Everyone's like, oh, this is it. We've peaked, right? We've troughed. The interest rates have peaked. The cost of living crisis has peaked. The property market correction has troughed. Is this the bottom? This is what people are saying, right? Based on those 2 months. And we've been looking at the data and talking about it and going, wait a minute, let's just hold on. Let's just look, because the price of Brent started going up a few months ago. So it was in that month that it went from 7.9 to 6.8. So a drop of 1.1. Everyone was like, hell yeah, look how well we're doing. Was when we saw Brent starting to go up massively. But because there's a lag period, it takes time to get into the data. So again, nothing has happened here that we haven't spoken about on this channel. I suspect interest rates will go up next. I suspect we'll see a rate rise next month, 2nd of November. So what's that? A couple of weeks' time, I suspect. Not 100%. I suspect we will. Sean, I think it's going to be above 5% into Q1 next year. Bit malicious, but I'm hoping it is. So Sunak has egg on his face for pledging to lower inflation when the government has no control over it. Yeah, I got to be honest. When he came out with that figure, I was like, "Ooh, that's a bold statement." And when you say you're going to halve inflation, which take it from what 10 to 5, basically at the time, you think, I mean, it's a bold statement, but it should be pretty achievable. To get it all the way down to 5, which is still 2.5 times government target, which, by the way, is an arbitrary target. 2% is a completely arbitrary target when you look at sort of economics on a macro level. It's just something that was set a long time ago and everybody uses it as target. But yes, I kind of agree with you, actually, because you're right. They have absolutely no control over it. It's nothing to to do with them, really. And most of this stuff has come from external supply shocks. Be it COVID, be it Brexit, be it Ukraine, Russia. Price of utilities, price of oil. Nothing. The government has not had any input into that. So when they come in and say, "Oh, it's dropped this month. Look how great we are." Come on. So I'm not totally against you on that, Sean. Mr. Eclectic, thank you. Good luck for the move. I'm looking to buy my first property in the next 6 to 12 months. What is your best guess as to where the house prices are going? When the house prices are going to drop most? Okay, Mr. Eclectic, this is very much a non-financial decision, best guess answer, because I don't know if you're new to the channel or watch a lot. I always say I don't like to make predictions on actual figures, actual numbers, actual dates. I think it's a fool's game. I am aware that lots of people that will, every time they go, put a video out, they'll put another figure out there. So then 12 months time, they can cherry pick the one that they were right on and say, look, I was right. I don't do that. I go live and talk about the trends and all the possibilities. However, my overall feeling, I would say, is the highest probability. So the possibility with the highest probability is that we'll see a little bit more interest rate over the next few months. It might get to 6. I don't know. I don't think it will. Then we'll see sticky inflation and the interest rates will persist. And I feel, right, looking at the data, looking when it all starts dropping off, summer next year, we're going to see inflation come down fairly rapidly, unless something that that nobody's expecting happens, like what's going on in Gaza Strip right now, changes the whole thing again. But let's just assume that we're carrying on current trends until we see something else materialize. Inflation should fall off next summer quite quickly. I feel the interest rates would start coming down at the earliest summer 2024, but they might be higher than they are now. So I don't feel they're going to be much lower to where they are now until the end of 2024. And I feel they'll be persistently high now. I want to say high 3.5 to 4.5% base rate for potentially many years, right? Maybe even between 4 and 5 for many years, potentially. We're talking a long way away. In terms of the housing market itself, I've always said, and I said 18 months ago when I put my own house on the market, that I thought max pain for the property market was going to be winter 24, i.e. December 23 into sort of February, March 24. Main reason for that being, so many people are now going to be coming off their fixed rate debt of 2% or less and onto much higher interest rates on their mortgages. It's the second winter that you're going to have high utility costs. And don't forget, just because the utility costs have come down considerably doesn't mean that's all passed on to us, because it was artificially reduced last winter with the energy price guarantee. And the government gave everybody, was it 500 quid, 600 quid to cover, help cover. So because of where the price cap is now, which is, I believe, just under £2,000 a year for the average home, the government aren't giving everybody £500-600. So actually, in reality, it's the equivalent of, it being £2,500 last year, which it was last year. The price, the energy price guarantee was £2,500. So utility costs are going to be about the same this winter as they were last winter. And they were expensive, and it hurt a lot of people. And that cost of living is going to rear its head again as we go into the winter, and everybody's got to either heat their homes, put food on the table. Now, food is improving, but doesn't mean it's actually getting cheap, right? Rate of change is coming down. So I've always said that's going to be the max pain. And then with the lag effect, we're going to see that into the summer of next year, because the transactions that are happening over winter, okay, we're not going to see that in the data until spring, summer next year. So I suspect in nominal terms, house prices will probably start to trough around then. A lot of people are saying and forecasting they'll go down a lot more than I think in nominal terms. But when you look at the house price to earnings ratio, which is effectively the best measure of affordability, it's come down a lot already. And this will cushion, I feel it will cushion where house prices end up in nominal terms. Okay. What I also think is that in real terms, so inflation-adjusted house prices, which is the real value of the asset, will continue to decline for a lot longer. The last three crashes we've had, or corrections, right, end of the 70s, end of the 80s, 2008, have seen pretty much bang on a 7-year peak to trough in real house prices. I don't see why this would be any different, especially with the high inflation we've had. So I could see real house prices declining, don't know by how much, probably gradually, until potentially sort of 2027, 2028. Whether you're if you're buying to live in, real house prices are really not such an issue. If you're an investor, I think it is relevant, because if you're buying something as an asset, as an investment, and it's actually devaluing through inflation, then it's not a great investment, right? A lot of people looking and go, oh, it's gone up in loads in nominal terms. Yes, but you could have put your money somewhere that wasn't eroding with inflation and got better returns, right? That's how I look at it. So I don't know if that answers your question, Mr. Eclectic, but that's my thoughts on where we are with the property market. Tall Rhythm Golf, how you doing? Defo some shenanigans going on. Stop this month's reporting a CPI rise. Yeah, totally agree. Maybe you put a Freedom of Information Act in or something and get it to 5 decimal places. I cannot believe that it has not gone up the headline figure of CPIH, looking at what's happened with the data. Becky, Bank of England will hold base rate high for a very long time. Could be 2 years. Yeah. I put a video a couple of days ago, Monday, where I put a graph from the IMF report that I talked about last week on the live, and they are predicting our base rate to be potentially around about 5% until 2026. So everybody needs to, I think, just adjust to this new world we're living in. What does that mean in terms of being a property investor? So if anybody here is, and give me a thumbs up if you're sort of into property as a investment or a business, what does it mean? Just with everything I've been saying for the last 6, 7, 8 months since I started this, we need 2 things, right? we're away from cheap debt, really available cheap debt, right? We are no longer in an era of property prices just going up. So we're not seeing those passive gains. So what we've got to do, we've got to be more active as property people. We've got to find properties we can add the value to in other means, not the market going up, not just a lick of paint and all of a sudden it's worth 40, 50 grand more because the market's taken it up. No, we need to find things we can add value to with a whole toolkit of skills and strategies and tactics, which there are loads out there, okay? When we do that, we can add value, we can recycle cash out. When we recycle our cash out, when we've added the value, the issue we've now got is our debt to service is going to be more. So we need to focus on property types that are giving us a huge amount of cash flow. Again, lots of great types out there. High density blocks of flats, HMOs, service accommodation units. So we just got to adapt how we do this, right? And what we have going for us as property investors is there's never been more opportunity. Trust me. The baby boomer landlord demographic is almost capitulating right now in terms of getting rid of stock. Okay, so there are deals out there all the time, and if you know what you're doing, I feel that we are in this period of accumulation now. If anybody wants to know more about it, they haven't downloaded the white paper. Please indulge me for 10 seconds or so as I put this up. I wrote a white paper on the current state of the market some time ago, a few months ago. It's totally free. It's a PDF ebook. Rob Stewart, global.com/white-paper. You'll probably be able to read it in about 20-30 minutes. It talks about all the tactics, strategies that are working right now in the current property market. I recommend if you're in property or you want to grow your property business or you want to start a property, you're not sure where to start, that is the place to start. You can also find that link in the description to this live stream if you want to do that. So there we go, team. That's it. Robert says, Great Depression is on the way. Oh, that's made me feel cheery, Rob, at the end of the live stream. Hopefully it's not yours or mine. It's just, well, actually, maybe it is better it's yours or mine and not the whole world going into a Great Depression. But yes, I get what you mean. This is not the happy feel-good times of other periods of history. That we've probably all lived through. And I think certainly since, even let's say since sort of Brexit, it's been one thing after the next, which is putting this string of facts together, which is fundamentally changing the society we live in. We've got two things. We can sit there and we can be, reactive to it all and be like, this is rubbish. Or we could make a choice. The choice is to live life on our terms. With all this talk about our rights being taken away from us, World Economic Forum with this whole, and by the way, I disagree. This quote I think is taken so out of context, but I understand the thought process behind it of we'll own nothing and be happy. I'll probably do a video on where that quote actually came from. We've got a choice. We could do that, right? You could be the person who doesn't own anything, or you could be the person who owns everything, right? And just proactively, rather than reactively accept everything that's going on, proactively go out there and take ownership, right, of your future. That's it. That's what I've got for inflation today. I'm going to be offline for, probably the best part of a week now. So I'll try and get the new studio set up at the new house so we can go live next week and talk about what I'd imagine will probably be the ONS figures for the housing market coming out. But in the meantime, everybody have a great week, great end to the week. Please do subscribe if you're new to the channel. I appreciate it so much. And I look forward to seeing you from a new pad next week.